It's non-farm payrolls day, so we're looking towards what the US employment situation might look like. And then we're going to look at dollar yen because it's been a bit of a crazy week for the pair. So we're going to find out whether there could be a trade idea on that currency pair. And then the trading takeout today is going to be keep it simple, and it's going to be related to the dollar yen idea as well. Before we get into today's video, though, make sure you hit subscribe and like this video so I pop up in your YouTube feed every day so that you can maintain your trading edge. So yes, it is indeed non-farm payrolls day today, with the expected number to be at 180k. The previous was at 150k, so it was a lot softer than prior prints. And the one thing that I've maintained with regards to markets in the economy currently is that employment is the key factor holding things up. I think if employment goes, then credit contracts. People aren't getting paid; they can't basically afford their credit. They're not going to take out more credit. And unfortunately, credit is what keeps the economy going. It's pretty crazy, really. But yes, I think that if we do start to see non-farm payrolls come into line with expected or into line with the previous, so we're looking at between 150 to 180k, I think that we're going to see some softness in risk. And I spoke yesterday about this. If we do focus on the S&P 500, so if I just go to the S&P here, let me share this tab. We had a rally yesterday, but it's still flattening out. And we're still seeing that kind of relationship with yields, where yields are softer, but equities haven't really rallied like they had been previously, like here, for example. And I think that NFP, if it does come in softer, should really affect equities in a way which is kind of anti the recent, softer yields, equities up relationship, basically. I think it just means that it's either going to be flatter for a while. Volatility ticks up a little bit. Volatility is very, very sold at the moment. The VIX is sold massively. And I think that, employment is continuing to be the thing that's holding things up. Now, if we look at continuing claims, let me just get that up. So United States continuing jobless claims. Let's remove the moving average and zoom in. You can see that since September, it's ticked up really, really heavily. The last week's print was lower. But I really, really think that this should start to have some feed-through effects. It's been on an upward trend since September of last year. So more and more people have been claiming unemployment. It's not necessarily reflected in the unemployment statistics, though, nor does it necessarily have to be reflected in NFP. But the print in the middle of November was the highest since, I guess, if we want to say, November 2021. So we are seeing that relationship of interest rates and unemployment be affected. And if I just put in interest rate, and we shove that on, you'll probably be able to see this relationship quite well. So you can see here that as interest rates started to get priced into the real economy, continuing claims ticked up, whereas previously it was completely coming down. As interest rates were coming down, interest rates go up and you see that go up again. So there's a clear relationship there with a slight lag of maybe 6 months or so, which is to be expected. Interest rates do take a fairly long time to feed through to the economy. Interestingly would be to see what happens up here. So do we start to accelerate here, or is that it? Is the economy actually sufficiently unemployed, if you like? It's barely moved, You do tend to have to see unemployment tick up before recessions, etc. though. So, I guess we'll wait and see. But this is one of the key factors that I'm looking at as a more sensitive measure of how the economy is doing. Continuing claims is a strong measure of this. So yes, feeding back through to the core of today's view, I guess, is that if NFP comes in softer between 150 and 180k, I do think that equities are, probabilistically going to tick lower a little bit. But it is dependent on whether the market instantly takes this as being, okay, the Fed doesn't have to hike anymore, or whether it takes it as being crap. Credit's contracting, defaults might go up, et cetera, et cetera. So pay attention to that, and good luck today. So we're at a very interesting place with dollar yen. Earlier this week, or just yesterday actually, we saw the dollar actually fall considerably versus the yen after the Japanese 10-year yield rallied by a hell of a lot, actually. We spoke about that yesterday. But we've collapsed into a place of really, really key technical support. And you can see how the market has behaved here. This is the 200 daily moving average. And if we look back at previous times where the markets, reacted off of this level, we can see exactly what's happened. So we can see here, for example, used as support. We can see here used as resistance. Again, you kind of get the picture. And here as well. So we can see there, bounced, came all the way through. So what's interesting here is that I don't think that there's should be any considerable follow through. I really, really don't think that Japan is able to hike going forward. It doesn't really make sense for them to, considering their growth prospects. They had negative growth for the last quarter, and they will be heavily focused on, how do they manage through this, considering the last 20 years of easy monetary policy has tried to result in inflation. They're kind of getting that inflation, but growth's collapsed at the same time. It's very stagflationary. So a concern for Japan, basically. But do we care about that? Not necessarily. I think in terms of probabilistic ideas, which is what I always love to speak about, a rally off of this 200 daily moving average is the most likely outcome here, especially if we do see a bit of a defensive play where NFP gets weaker. Growth prospects globally are already quite weak. If NFP is weaker, then we might see a bid on the dollar. We've already seen that the euro has, fallen quite considerably through the week. So if we see a reversion here for dollar yen, it could mean that, we start to see levels like 145, maybe even 146.25, and test this resistance turn support, or test that support. It's not yet resistance, is it? So that's the way that I'm looking at it. It's very key level. It's not that difficult to understand here. It's pretty much just mean reversion that we're looking at here. And that's probably something to touch on, actually. It's always important to identify exactly what you're looking for in the market. So I did a video a couple of weeks ago, and when you're trading, you got to say, okay, why am I entering this trade? Is it a mean reversion trade, or is it a trend trade? Once you've defined that, you can then define exactly how you manage that going forward, whether you're going to pyramid in a little bit, whether you're going to go 75% of your original size and add the rest in a little bit, versus splitting it up into more because you're going to be in the trade for a longer time. So these are ways to really identify exactly in your mind, sort of cognitively, what you're about to do. Here, for example, if I were trading this, I would probably go in a little bit higher size because I'm expecting a faster move. I might not get enough time to pyramid in. I'm not saying or suggesting anything here. It's just purely what I might do. And I think in terms of this, we've already seen this tail form. A big doji, shadow, if you like, shadow here. Big shadow here. Let's switch it on to candles just so people can see it better. I always forget that I use candles, bars. Sorry, I know people use candles mainly, but you can see here that you might want to look at this as a level for it to touch. If this is a strong technical place for the market to be, which I think it is, the trend is up. It's quite clear to see. I hope you could see how simple that idea on dollar yen was, because that's basically today's trading takeout, to always try and keep things simple within a way that you understand the market. I'm not someone who enjoys maths. I'm not a quant. I can understand quant stuff if it's broken down in a specific way, but it wouldn't be my go-to to try and to understand exactly what's going on in a market. What I prefer to do is look at qualitative things. So sentiment, how have people behaved before? What are people's views on the market now? What ways have I used certain topics or themes previously that have worked, and do they apply now? Using all of these kind of things rather than saying, okay, this is what the data is saying, XYZ moves by this amount over this period, and so I should do this now. That doesn't work for me. It doesn't compute fast enough in my head. So always try and keep to the things that are simple and you can understand quite quickly, because that's what you need to do. You need to have pretty quick recall in trading so that your subconscious is acting with your more real-time conscious. So that is today's trading takeout, to always keep things as simple as possible.